Well, hello there, ladies and gents. Great to see you again. Welcome back to Path to Abundant Living. Ryan Ruff, your moderator, alongside Matt Nordmann and Scott Morrison of Morrison Nordmann. And today we thought we'd make our episode all about you, our audience, and that is answering some of the key questions and the high level conversations that Scott and Matt are being peppered with this time of year. These questions range really, though, they run the gambit. It's anything from future wealth planning efforts, interpersonal relationship, family issues surrounding wealth. We're going to hit a lot of topics today. I guarantee you, if you're tuning in today's episode, at least one of these questions has probably been at the forefront of your mind. So before we get into the weeds of all the different topics we're going to hit today, let's say hi to the fellas. Matt, Scott, good to see you guys. How are we doing today?
Good, Ryan.
What's up, Ryan?
Nice to see you. Hey,
Scott, nice
Matt.
to see you.
You too.
Summertime, Scott.
That's right.
I
Got
feel
sleeves on. It's 80 degrees out.
it's 80 degrees. I know Ryan was just talking about golf. He's not going, but as I think you said, it was your cousins going up to Arcadia Bluffs.
That's right. He's visiting your neck of the woods. He's going to tee it up. I hear the weather is relatively lovely this time of the year up there in Michigan. But yeah,
Beautiful.
it's a good time.
You might need a little pullover in the morning, but other than that, it's
Just
hard
remember,
to
it's
find a better
always 10 degrees cooler on the lake, on the big lake.
Noted. Well, when I make a house call to you guys, I'll make sure I bring the sleeves.
right.
So, guys, look, we've got our hands full today. A lot of questions have been coming into your office. It's that middle of the year time where folks are looking back at past performance or looking ahead to future planning, and all sorts of questions arise right around now. So let's start with the big one. Look, high net worth families, and we've addressed this on this show in different ways, shapes, and forms, but high net worth families are looking for a lot of different methods and ways to educate their children on financial responsibility and also that sense of purpose that the family and the family dynamic brings. But they also want to make sure they're avoiding issues of entitlement and all the negative actions that can come with that. So let's open it up talking about family wealth here. What are you guys saying to these kinds of families? What are some tips or tricks on how patriarchs or matriarchs can address that next generation about the family's wealth?
First and foremost, be willing to have a conversation. A lot of times people ask, well, do I have to tell them everything and like to the penny, like where the money is? If you want to, you can, but you don't feel that you need to go that detailed, but have a conversation about money. Like that's one of the biggest issues that families don't talk about, right? They don't teach their kids about money. They don't talk about money. And really, what is it that the values that you want to pass on to them? Now, again, you can get really detailed if you want to. And, you talk about that sense of entitlement. When was talking with somebody about this, and he deals with billionaire families, and he had his trust redone, and his wealth was going to be left to his son, who at the time was 12, but he said, hey, I want to, when he's 21, he gets the money. Well, they read through the trust and everything, and he had actually said he gets the money when he's 12. So if this guy had passed away, and quite frankly, the consultant was like, I would rather your 12-year-old get $1 billion than your 21-year-old get $1 billion. At 12, he's going to buy, Game Boys and PS5s for him and all his buddies. At 21, they might end up in Las Vegas or something worse. So it's be willing to have conversations and in your family, what is it that you want to have happen? And so that conversation around money of, well, we don't want them to become entitled and, quite frankly, a degenerate, right? And blow through this family wealth and saying, okay, what is it that you want to pass on? And it starts with a conversation.
I think too, I've got 30-something-year-old son and two daughters. And, when you start having some of those political conversations, and they always lead to discussions about greed, or they lead to discussions about how money is squandered or misspent, having conversations with them about what's passionate for them. When they start thinking about the causes that they have and the solutions that they have for world problems that they're so easily able to point out, you can say back to them, well, what would you do differently? if you were running a foundation or a donor advised fund or some of that, because that naturally leads into how do you fund some of these things that would be important in your life, beyond just what are you going to buy next, with dad's money. That way we're not talking about what car they hope to have someday, but we're talking about if they really have a cause about disadvantaged families and children, and if they have causes about the environment or whatever it could be. There's foundations and there's donor advised funds out there, and knowing the finances of them certainly goes a long way to addressing some of those things.
Yeah, I mean, at that point, Scott, we're talking about purpose and identity, which is just a great foundation for where wealth can go. That's a great place to start. I love this, guys. Um, Next one on the docket from a lot of clients. I know you guys are having these conversations actively. Like I mentioned, here we are kind of about the middle of the year, is all about the long-term goals. So next big question is, are long-term goals still on track? Are my goals still on track? How are we looking? How can I protect or insulate myself based on this political event or this socioeconomic event or market volatility? What say you to that classic question, if you will, that is asked right around this time of year?
Well, if anybody ever turns the television on and watches any news, regardless of the channel, opens up their phone, gets on their computer or their tablet, we are inundated with political, economic, and social uncertainty all the time. And we know that fear is a big motivator in the world, fear and greed. And fear sells, right? Because I need you to click on and or tune in. And so it's taking a step back and saying, okay, have your goals changed? Has your timeline changed? And do you have the foundation in place for what it is you're trying to do? Right? Currently, right, there's a lot going on in the Middle East. And quite frankly, some would argue there has been for 2,000 years or 5,000 years, right? And taking a look at, okay, what are those events and how do they affect what it is that you're trying to achieve? Do you have your sleep at night money, right? That doesn't matter what's happening in the world, whether it's here in the US or around the world. It's knowing that I can always have access to funds, that it doesn't matter. They're not going to be affected by what's happening day to day, week to week, month to month. Then you have that opportunistic protect phase, and then you have that long-term phase of money. And it comes back to, what are you trying to achieve? And do you have a good foundation? Do you have a good portfolio? For those that remember the housing crisis, if you owned a home in 2007, 8, and 9, and 10, 2007, you're like, my house has never been worth more. 2010, you're like, man, I just lost a ton of value. And the question would be, well, are you moving? Well, no, but it's worth less. Well, okay, but do you like your house? Is it a good, do you have a good foundation? Is it providing shelter for you and your family? Yeah. Okay. It's worth less today, but you're not planning to move, so you're not selling. It's that, I don't want to say that simple game, but it's buy low, sell high. And at that time, it was worth less. Well, now we're, fast forward 15 years later, and it's even been before that. Home values are in many parts are skyrocketing. I just had a neighbor sell, and I was like, well, if his house is worth that much, we might have to consider selling. Not really, but you just have to wonder. What say you, Scott?
Well, I keep thinking, when I hear somebody throw out the word long term, the one thing I have learned over the course of my career is that my definition of long term is not yours. It's not the person that happens to walk it. Everybody's idea of long term is different, because if I'm sitting down with some 21-year-olds, long term is next year. Whereas I'm talking to somebody who's in their 50s, they might be saying long term isn't until my life expectancy is up. It's what I plan to pass on, or for inheritances. So I think the first thing is making having a really clear conversation with the client about what's long term to them. And if it turns into a period of time of 10 years, 15 years, 20 years, then I would point to a timeline and say, how many different things happen in any given 20-year period of time, whether it's an election, whether it's a catastrophe, whether it's a war, whether it's, 12
Pandemic.
rate hikes in a year. I mean, just point at every given market condition, situation, whatever, over any 15 or 20-year period of time, and then just say, okay, in every one of those, there was not a negative period. They were all positive. So if your long-term goals are that long, then you're probably, if properly diversified, you're probably going to meet your goals. Mm-hmm. But if you're thinking about the next 15 minutes or the next 30 days or the next 6 months, then as Matt alluded to, we each have money that we walked into each of our offices with a wallet in our pocket, because that's what's the only dependable thing we have between here and home to pay for gas, groceries, and whatever the case might be. But at the same time, if I need to plan for something 5 years down the road, 10 years down the road, then I'm going to have a portfolio for each of those segments of time. And I'm going to know what the real risks and realities are of those holding periods and invest accordingly. So I don't know that I'm going to have one pot. I'm going to have, as Matt alluded to, my what if money, my rainy day fund, my growth. All of those different things are part of somebody's planning or part of their portfolio. It's just that it's just real important to be clear with your advisor about what is long-term to you, what's short-term to you, what is risk to you, because each of us has our own understanding of what that is.
Yeah, absolutely. And we had Adam Butler on this show a while back talking about that emotional side of investing. I mean, that is not a place anybody wants to go. And if anybody does, I mean, I would absolutely recommend, if you have not had a chance to tune into that episode, gosh, Adam was a great guest. A lot of good stuff surrounding the investment portfolio. And speaking of, and I don't mean to sound redundant here, but this is just such a big question that I know you guys get peppered with is, how should I be adjusting specifically my investments or my investment portfolio given upcoming political elections and landscape shifting, like portfolio allocations and sector exposure? This is all very, I would say, normal when people feel emotionally charged about making adjustments to their portfolio given political and socioeconomic elections and things like that coming up. So what do you guys say specifically to politics versus investment for portfolio?
You just said it, emotionally charged. We all have emotions tied to our money and wealth. And if I've said it once, I've said it 100 times. It is I don't care how people vote. I care how people vote, and I don't care how people vote. In that, when I say I don't care, what we want to know is whoever is going to control on the local, state, or national level, right, is one party going to control, and I say control, have, all three branches where they can push stuff through. Let's say when gridlock is actually, we don't like gridlock. We want to see things get done. But if there's gridlock, you don't generally see one party do one thing. But we've had it, right? We have it currently. We had it with President Obama, right? You get times where one party controls the House, Senate, and the White House, which I know that's not all three branches, but you understand what I'm saying. So when you look at it that way, we say, okay, what is it that possibly could pass legislatively that may affect things economically and how we as consumers will spend money and businesses will continue to spend money, and will they continue to try to expand, and how will that affect not only that short term, but also, like Scott was alluding to, that long term. And everyone's long term is going to be different, but that's when we look at it, that's what we're looking at, is who's going to get elected, because we know that if we turn on the news again and watch this person and this party and this district and this senator and everything, it gets everybody ramped up and say, okay, let's take a step back. How will that affect things economically? We understand politically and socially, but how potentially, a few years ago, there was the potential that the estate tax was going to go from, I think it was like 10 or 11 million back down to 4 or 5 million, which that would affect a lot of families. Doesn't affect many, whatever the numbers are, but some families are like, wow, if this passes, that's going to really affect how I look at my wealth and what that generational impact could be. If it's, half of it all of a sudden is going to get taxed at a, 40 to 50% rate.
I think about all of the studies that have been done on campaign promises. If you follow the campaign promises, how did those investments actually do? And very few of them had positive returns. So it just kind of makes me think about that, again, going back to that diversified portfolio, that if I own technology, I own financials, I own healthcare, I own infrastructure, whatever sector I'm going to own, I may adjust it slightly. I might have some weighting changes, but I'm not making wholesale changes to a portfolio based on a campaign promise, because they rarely come true. And campaign promises are great leading up to the election. But once somebody's actually elected, there's a lot more people in the middle than people would care to realize. And you start all of a sudden going to the extremes of both parties and trying to appease the extremes of both parties, you end up with a lot of unhappy people in the middle. And so it just kind of, it's not the sexiest portfolio to talk about, but it's the one that's most diversified, is probably the one that gets you through the uncertainty around an election or any of the other uncertainties we run across.
There's been studies to say, okay, if you have House and Senate under one party, president under the other, and every variation of that, to say, okay, 1 year, 5 year, 10-year returns after this election and that. And if you look at it, they're all positive. Once you get out a certain time frame, they all are positive. It's just at different times, one is higher than the other. So it's, again, like Scott said, have that foundation, have that diversified portfolio. Isn't the one that's like, oh, you own the Mag 7 and oh, you own all Nvidia and yeah, well, it comes back to what are you trying to achieve and what's the time frame, and having, okay, you have that segment for that, this segment for this segment for this. And do you have your sleep at night money? So regardless of what's happening, because there's always going to be something, right? There's always going to be something.
Yeah. It's diversify, it's hold the line. Just watch how things play out over that long-term period of time. As Scott mentioned, to some people.
Well, I would give you one more example I would give you is when all of the tariff talk was going on and a lot of the conflict was going on with Russia and Ukraine, and then the Middle East started up. Everybody, there was in some ways there was a lot of anti-American campaign around the world in terms of media coverage. President Trump was not the most likable person around the world. And guess which asset class did really, really well when the U.S. was struggling? Well, the international markets did really well. Well, if you had 10 or 15% in your portfolio that was either international or emerging markets or whatever the case would be, your portfolio, actually kind of the losses were kind of softened on the U.S. side because of what you had internationally. So it just reminds me that with every problem, you got to understand what the psychology of a money manager is. It's to make money no matter what the conditions are. So in these portfolios, there's somebody who's constantly looking at how do you tweak it to take advantage of whatever scenario is out there that
opportunities.
Where there's an opportunity, there's a solution, and solutions can be profitable. So sometimes solutions can overcome the losses attributed to a problem.
Sure. No, guys, this is good stuff. I'm I can tell the passions behind it because you guys are probably getting peppered with these questions. Fellas, the next one, I want to kind of jump back to a point Scott made earlier about like a family pouring some of their energy, their effort, their wealth into the causes that they care about. There's been a growing demand for this kind of thing, of using wealth for good and prompting inquiries for impact investing. How could somebody here and now better match or align their investments with those personal values or those causes they care about? Where do they start?
Well,
Jump
I
in,
guess I
Scott.
would jump in there and say that the nicest thing about what they call a separately managed account is there's a lot of individual securities in there. So you can actually have control over which stocks you want in there, which ones you don't want in there. If there's a particular company that you just can't wrap yourself around emotionally or with your value system, then it shouldn't be in there. Whereas in a mutual fund, a money manager runs that mutual fund the way he thinks it's best for the greater good for the majority of the holders of that mutual fund. So it's not as geared towards your needs as something where a separately managed account would be. So obviously there's socially conscious funds out there. You can invest in those as well, that are designed for all kinds of investing without it being in alcohol, tobacco, certain vices, that kind of thing. But then there's also, like you said, if there's a certain cause that you have and you know that there's certain stocks that are going to support those causes, then, when you're putting together that separately managed account, then you can weight your portfolio accordingly to those causes.
So as an example, we have clients who are passionate about certain things, right? And they will tell us, hey, yeah, I want that fully diversified portfolio, but if it's possible, I don't want to invest in this company. And we won't pick out one, but there's been more than one, right? There's a fair number of people who are saying, hey, I love everything, but I'm not a big fan of this company or this industry. And so you can actually exclude companies, industries, or countries from your portfolio to say, hey, that doesn't align with who I am and my family and my values. And then the other thing is, you touched on it earlier, Ryan, is like, and Scott too, a donor advised fund where you're saying, hey, I want to invest this money knowing that I'm going to be donating this to charity. And then say, okay, here's the charity that aligns with my values. And so how do I make sure that I have money invested in that way for what really matters most to me and my family?
No, this is great, guys. I think there's probably a very big contingency of our audience that didn't necessarily realize that you can go in there and be as meticulous with your investment strategy so that it does align with those values. This is really good stuff.
I'll tell you personally, yeah, for my family, there's a few companies that I'm like, yeah, I don't want them in our portfolio. And so we talk with the investment team and they know, yeah, it
But I
could
also
be.
I also think about those clients that we have that come in and say, they're first focused on how do I do something in a tax efficient way, or how do I protect from the tax drag, but I haven't really identified who that charity is yet. The greatest thing about that donor advised fund is it can go into a position that is irrevocable. So then therefore to the IRS, it's considered a gift. But you just haven't yet named who that charity is going to be. So it gives you the time to still do your due diligence and hear from those charities and make sure that it's going to be stewarded the way you want it to be stewarded.
That's
And
great.
so there's a lot of wealthy people out there that have started donor advised funds. And guess what? Wealthy people became wealthy for a reason. They were successful people. They're investors themselves. They've started businesses successfully. And so they know that sometimes they're not ready to pull the trigger on who they're going to give it away to, but they know they're ready to commit it to charity. And
Mhm.
so, I think the donor advised fund is really a pretty exciting, piece for those people they're so invested in their own businesses now that they haven't really taken the time to figure out where to go with the charitable giving, but it can still get that tax benefit by putting it into that irrevocable position.
Sure. Scott, I'm going to skip our next question because you brought up kind of that tax efficiency element of the conversation. And that was a beautiful segue. Let's move into that question. And I know that's a huge one for you guys is, hey, look, guys, how can I make my portfolio a little more tax efficient? Am I doing everything I can to save on taxes that are within my power at this current stage? What do you guys say to these kinds of questions? Because obviously everyone's situation is different. So what seems to be the go-to these days?
It's understanding how investments are taxed first and foremost, if we're only talking about the investment portfolio, and there's other tax efficient things that people can do. But if you look at the portfolio itself, as Scott alluded to, a mutual fund is built for lack of a better term, the masses. And so that fund is built, and by law, any capital gains that are earned inside that fund, they have to distribute those at the end of the year, 95% of them. So they have to distribute those gains at the end of the year. So they could have bought a company, let's say Apple, buy Apple at 100, sell it at 200. The rest of the portfolio was down 15%, but because they made money on that, there was a gain there, they have to pass that gain on. So you could lose money in your portfolio and still owe taxes in a mutual fund portfolio. And people are like, how is that even possible? Well, that's how. Whereas if you have a individual separately managed account, an account built specifically for you that nobody else owns this portfolio, it can be managed in a way to minimize any gains that happen and or tax loss harvest. If there's an opportunity where the portfolio manager and the investment team can say, hey, Ryan, we see that we're up big and we want to harvest some of those losses during the year, because not every position always makes money every year. And so it's being purposeful and intentional with the portfolio and working with the investment team to say, okay, what are we trying to achieve? And having the plan to say, hey, we can harvest some of these losses, because again, not every holding goes up all day, every day.
No, that's good. Scott, any tricks up your sleeve?
Well, I think just adding on to the tax loss harvesting, I just think about, the CPAs, they're the ones who end up calling the advisors to say, we're anticipating this big capital gain, and is there any way to look in the portfolio to harvest some losses somewhere? And typically they're calling in December, which there's a year of the tax year left. That's not purposeful, intentional, or tactical in any way,
Or planful.
You're just hoping that the timing works out where December happens to be down and you're trying to find some losses somewhere. And I think for a lot of clients, they don't even want to hear the word losses. What do you mean we're going to do tax loss harvesting? And I don't want to hear the word loss. And what we're really trying to, share with the client is, listen, your portfolio has done so well, the majority of it, that this is an opportunity. If we sell off a certain sector or a certain fund or a stock, we can actually intentionally give ourselves a loss, take those proceeds, immediately buy another stock in the same sector, so that when it does recover, we'll recover that. We'll recover those losses the share price will go up. And we're not taxed on share price gain. We're only taxed on, as Matt said, capital gains, things where something was either bought or sold. So if we can do that in such a way throughout the year, then we have multiple opportunities. If we're looking at that at all times, looking for opportunities to tax loss harvest, then we're not being reactionary. We're being tactical. We're being proactive. And oh, by the way, at the end of the day, we're also building tax basis. So the more tax basis we have in our portfolio, that's certainly going to be more intentional about how you plan for inheritances as well. It'd be nice to inherit something that doesn't have a large, taxable gain associated with it.
Yeah, no, this is great, guys. I'm sure that's a really big one. You're having a lot of conversations surrounding these days.
Scott alluded to, hey, working with the CPA, what we see a lot of times when we first meet with people, right? It's that coordination or lack of coordination when we talk about this all the time, lack of coordination among all the professionals that you work with, right? We talked about it on the show many times where, hey, Ryan, your CPA tells you go talk to the attorney who tells you talk to the insurance person who tells you to talk to your financial advisor who tells you, and you play telephone, and next thing you know, it's like, I don't know, instead of coordinating all those people together to say, okay, and throughout the year, right? It's not only December, but it's like, hey, in April of last year, when Scott alluded to, hey, tariffs are announced and market drops dramatically in that short term, it's like, that's an opportunity. Is it an opportunity to harvest those losses? Because guess what? Everything came back a lot higher. And so now you have these losses that you can use in that year and or carry forward, because people forget you can do that too.
A lot of tricks up the sleeves, guys. This is good stuff. All right, here's a big one. And it's funny because it happened to me this morning. This morning, before I sat down and fired up the old laptop for work and whatnot, I took a quick trip out the door. I filled up my gas tank. I grabbed some milk and some eggs from my grocery store. It was pretty appropriate morning. I come back. What do you think that trip cost me?
Well, it was $100 all day. That was
It was
$100.
It was $100 on the nose. It was like $100 and like, I don't know, 20 cents or something. And I chuckled to myself because I knew we were going to have this conversation today and I knew this question was on the list. And I was like, oh, this is so perfect. So guys, inflation, it's happening big time right now. And we're really feeling it in those everyday goods like groceries and gas. So the big question I know you're being hit with is inflation and the cost of living like ever going to feel normal again? And how do I managing like, or how should I manage or maintain my personal power against that inflation that feels so tough to, mush through right now?
I hate to do this to you, Ryan, but I'm
Please
going to say,
don't.
okay, I'm saying you're probably what, in your mid 30s?
Yes, sir.
Okay. So you didn't own a home in the 70s and you weren't buying goods and services in the 70s when inflation was double digits. Okay. So I think what some of the younger folks have not gotten a handle on is how normal this is.
Mm,
These rates are
mhm,
normal, historically speaking. Now, having said that, when you think about the costs, well, how do you offset the costs of gas? It's probably a good play to own some, right? If you have a little bit of maybe a 5% sleeve in your portfolio that's energy, if you have 5% in your sleeve that's infrastructure or commodities or consumer goods, utilities, all those things that those prices are going up. When your portfolio reflects ownership in those things, it goes a long way to doing that. Now, the other question is, well, and I know it's one on here is, well, why wouldn't I just put in, to a CD where the interest rates are higher or the money market or whatever, is to remind people but that's where inflation is. And if the money's only growing with inflation, it doesn't matter what the interest rate is, because if interest rates were 12%, but inflation is at the same rate, you're not gaining anything. And there's never going to be a fixed account that's outperforming inflation, or if it is, it's going to be very minimal. So where do you get that equity? You have to have some ownership in those things that go up. And I think that's
yeah.
something that people are learning the hard way.
Yeah. I like the idea of offsetting that. I mean, that tracks with me. Matt, any thoughts you're in?
Yeah, in the 80s, inflation, there was 12, 14, 15% because people will say, I remember I could get a CD that paid 13%. And I said, you could, and inflation was 15% that year. And so, as someone pointed out, you were going broke safely, right? Because you were losing that purchasing, but I made 13%. Yep, and inflation averaged 15, so you lost two. And oh, by the way, you had to pay taxes on that 13. So you're going broke safely. And so it comes back to the timing and what are you trying to do? And you have that short-term money, that the goal on that short-term, that sleep at night money, is not to outpace inflation. It's to, if you can, keep pace with it, but know that that money is there, so it doesn't matter what's going on in that medium and long term. I just told it again. I met with some people today. My father-in-law is going to be 90 this year. He born in 36, graduated high school in 54, and so I think this was 1956. I have to go look at it. He has a pay stub, one of his very first pay stubs, working at Michigan Bell. He was a phone man for 40 whatever years. Anyway, he made $1 an hour, $1 an hour,
Wow.
and that was enough, right? Because that's all you needed. And he worked overtime and made, I think, $52 that week. And you could do fine on $52. Well, and then you fast forward to the 60s and the 70s and the 80s, right? And it's going to be the same thing. What was kind of this baseline? Hey, if we can average I know the Fed's goal is 2% inflation, 2 to 4. That's great. Stuff is always going to go up. It just is.
It's just what you mean, how to get the problem is that how does it get to the 2 to 4%? It's not like everything's moving at 2 to 4% because we can look at college tuition, we can look at energy, we can look at all of the things that are going up by healthcare. I mean, 7% on the low end, so it's some of those things that hurt the most are the things that we need the most. Where you don't have as much control. But the whole idea of raising interest rates from the Fed's perspective is to purposefully slow the economy down, which curbs spending, and then hopefully prices come down with that, because maybe there's some greed out there that is part of the price structure that people are most upset about.
This is good stuff, guys. Next one on the board here. Clients are weighing in these days on psychological and the mathematical differences of paying off mortgages and loans versus taking advantage of the prevailing markets that exist, and also savings on interest rates. Should somebody in today's moment, if you will, pay down debt or invest any of the extra cash that they might have?
Well, we hate to use the word it depends, but if you listen to Dave Ramsey, right, which has a lot, Dave has a lot of great things to say. He would be
Always
like,
pay down.
always pay down debt. That snowball, get rid of it, get rid of it, get rid of it. Well, what if your mortgage rate right now is 2.75%, and in a money market you can make 4 or 4.25? Seems like you're losing money. Now, again, there's that emotional tie of, I think of a client, she was like, I want no debt anywhere at any time. So it's like, okay, then that means we're going to pay off, because there's that emotional side of money that we need to make sure we talk about. And what's your time frame? Because you could say, hey, if you get a mortgage rate at now, I think roughly 5.5, maybe in some places. What's your time frame, right? If you look at historically and you invest that money, you would have done significantly better over that 30 years. Well, but maybe you don't want to do that. There's that emotional tie. So you hate to say it depends, but it depends. What are you trying to achieve? And you have to take the logic side of your plan and tie it to that emotional side of your plan.
Yeah, I think I get the question all the time. It's a different answer for, whether you already have a mortgage that's at that 2.75 to 3.25 range, because that's what people had 4 or 5 years ago. And you can certainly point at their portfolios and say, why would you take money out of something earning 8 to 10% to pay off something that's, got a drag of 3.25 on it? Why not just let that continue to grow and make larger balloon payments later if you want, but let that money that's working hardest for you. But today, the person that comes at me today with their first dollar, do I invest it or do I put it toward my house? That's a much tougher question, because if they're making 6% in their investment and they're paying 6% on their mortgage, can I guarantee that their investment's going to make 6%? No way. So, if there were a time, and at least the time and place now, you could probably certainly agree with Dave on this, or Mr. Ramsey would be, I would lean more towards paying off debt when our interest rates are where they're at currently. But again, it goes back to how disciplined will you be? Will you put a little extra towards your mortgage to help, shorten that term? Will you be aware of, when there's opportunities to refinance? Will you continue to save out away? Those savings that you do make, will they be consistent? Will they be disciplined so that you do earn the 8 to 10%? Because if you go out and just spend what you have, then you haven't accomplished either one. You haven't accomplished getting your mortgage down, and you haven't accomplished investing enough where you could make a balloon payment later. So some of it's just going to come back to just, the discipline.
And the timing, because again, if you put it in cash, which is fine, understand inflation is going to be eating away at that just as much as it's going to eat away of any of your other investments. Because people talk about risk and like, I don't want to lose my money. It's like, yep, losing money is a risk. not earning enough, not keeping up with inflation is a risk, going broke safely is a risk. Currency, right? There's all kinds of risk, but the emotional side is I don't want to lose my money. And it's right. Let's talk through that and say, okay, are you going to feel better? Are you going to say, oh, I'm so glad I did, or I wish I would have?
Mm-hmm. Guys, this might be another similar question from kind of the same vein. And Matt, you had alluded to CDs a moment ago. Right now, people are tempted by the high yield cash accounts or CDs. Why should somebody stay invested in the market when cash yields are looking so good?
Scott alluded to it, talked about it, right? It's the time. If it's your short-term money, that's cash, right? That's CDs, that's money markets, that's high yield savings. But if you look at, I just met with clients and their portfolio, again, if you look back over the last 12 months, with everything that's occurred, outpaced any savings by a significant amount. This wasn't a super high equity position. It was a good balanced portfolio. They outpaced any high yield savings or CD or money market by a lot. Again, doesn't always work out that way, but when you start saying timing and time in, yeah, if you look at historically, which again, past performance is no guarantee of future results. When you know that, it's like again, what are you trying to achieve, and what's the time frame you're trying to achieve it?
Nope, that tracks pretty much. Guys, I can't believe we haven't hit it yet. AI. It's one of the biggest, hottest topics, obviously, with regard to any sort of investment or stock specifically. Would you say right now is the stock market specifically that is driven by AI in a bubble at the moment?
It's a really good question. There's always a bubble somewhere. It's just how big is it, and when will it pop, or when will we see pullback, right? That there is so much that is occurring with artificial intelligence. It is truly amazing and a little scary at the same time, right? We are being tracked everywhere we go, every dollar we spend. And so, you know, there's a ton of money going into data centers all over. And when you look at how that's going to be, so to predict we're in a bubble or not, well, right? If we say yes, we'll be right at some time. If we say no, we'll be wrong at some time, right? What did somebody say? It's God created economists to make the weatherman look good, right?
I like that.
Because because what's going to make a headline, right? We saw the article that came out, what was it, in February or March, about how AI is going to replace half of all jobs, or I can't remember what the article said, but it's like, hey, if you have a job, you might as well start looking somewhere else because your job is going to be replaced.
The thing that I find most intriguing is when people talk about a bubble, they're instantly referring back to the internet. When we were in the late 90s, that internet bubble, but it was all based on a lot of concept. It was the opportunity and the potential opportunity of the internet. There weren't any earnings associated with the internet. It was all about what we think we're going to be able to do with it. We're not dealing with that same issue with AI. We're talking about things that have earnings. We're talking about profitability. There are real numbers associated with AI. So it's not all conceptual. I mean, certainly there's a lot of stuff that is on the supercomputing side that is still hypothetical in a way, but we're using, AI, and we're in our meetings, AI is transcribing our meetings and giving us back the homework that I have, giving back the homework to the client. It's all measurable, and it's something that is, showing up in in a company's profit, loss records. So I think it's hard to call it a bubble. It happens to be a very exciting new technology, and this is somebody talking with less hair and more of it's gray than anything. Is I think the exciting part about it is I don't know that we're even close to a bubble, because I think that it's so still on the verge of the growth is there. I mean, it's being demonstrated. So I don't know that, are we going to accomplish everything they've talked about in the next 5 or 10 years? I don't know, but we've accomplished so much and there's profitability there. I think that's the difference.
No, it's good stuff, Scott. Appreciate that chime in. Fellas, before we wrap up today's episode, our final question. We started talking about the future generations and inheriting wealth and some of those key conversations. Let's go back to those future generations to end it today, specifically with regard to national debt and the federal budget deficit. How do you view those two things affecting our future generations?
A good question. The future will tell, but we look at it as, okay, a percentage of GDP, the gross domestic product, and we're about 100%. National debt is about 100% of the GDP. It's not the first time it's been there. It's like, if you kind of look at a graph, it was north of 100% years ago, dipped back down, and we're right back up there again. And people, oh, we're spending more than we've ever spent. Well, yeah, the dollar number is bigger. It's many trillions as opposed to what was billions and what was millions, right? But as a percentage of GDP, do we want to see the federal government and state governments and local governments get their fiscal houses in order? Yes, of course, right? Because when you look at, okay, just the percentage owed on that debt, right? If rates change a lot, right, all of a sudden it becomes a much bigger issue. So it's not the first time we've been here, and I would like to think it will be the last time, but I know it won't be, right? Because we know that people at even local, state, and the federal level have a problem with spending. And compared to what we do in our own personal homes, they just continue to run debt, run debt, run debt. And the modern monetary theory says, well, just print more money. Well, that doesn't work. It doesn't work. Some say it does. You hard pressed to convince me that will ever work.
Scott, what say you?
I guess I like to tell myself that I'm in the right career for helping people become as financially independent as possible and not be dependent on entitlement programs. I don't think that's the goal of a financial planner, is to help them find, what tax dollars will pay for. Maybe this is just, again, where people ask me all the time, and I don't know whether it's to vet me out as to whether or not they can invest with me or be their planner, but they ask me what my political leanings are. And for me, it's one of the things where I can honestly say I'm probably more socially liberal, but I'm fiscally conservative, which is a heck of a mix, because I believe there's real issues out there. I believe there's real causes out there, but people issues are people issues, and I don't think there's going to be solved with any government entities or monies. So we have a lot of talking to do with each other, and I think if that happens, we can grow as a society to be more independent in terms of, if we're talking about wealth and careers and things like that. But yeah, it's scary, especially for my grandkids. I think about that all the time, what we're passing on to them. And so, yeah, go back to question number one: what are we talking to our future generations about? If we can be less dependent on the government, I think that's probably the best direction we can take ourselves.
Gentlemen, this has been an immensely valuable conversation for our audience. We hit some of the high level questions that they are already asking you, and you're having these conversations with your clientele. For anybody out there today, if we really kind of hit a nerve with them on one or maybe even multiple of these questions, and they're thinking to themselves, I should probably bend Scott and Matt's ear about my situation, how it reflects their answers on this podcast today, what would be the best way somebody could reach out to you guys and just start that dialogue?
Go to the website, Morrison Nordmann, 2 N's on the end.com, morrisonnordman.com. Click on the link there to schedule a get to know you call, or call us 517-333-7967.
Fantastic. Well, gentlemen, look, I know you've got more of these conversations to have today with clients, so I'll let you get back to that, but always appreciate the time, and we'll see you back on the next one.
Great to see you, Ryan. Have a great day. See you soon,
Thanks,
Scott.
Ryan.
Of course. And look, folks, as a final moment of thank you, we wanted to thank you, of course, for stopping by and spending some time with us today on the podcast. If you learned a thing or two, if you enjoyed the conversation, please take one moment and hit that subscribe button on whichever platform you checked us out on today so that you don't miss out on future conversations where we dive into wealth management topics and or bring on some really unique guests to the show to help put you on that path to abundant living. But look, for Matt and Scott, I'm Ryan. We're going to go ahead and say so long now, but we appreciate each and every one of you stopping by today on Path to Abundant Living.